Today, we're peeling back the layers of the financial facade, revealing a dire truth that could impact us all. According to a recent report from the New York Times, banks are unexpectedly closing personal accounts amid the ongoing credit crisis, aiming to mitigate the risk of losses and failures. The worsening financial conditions are putting many institutions in challenging situations. Simultaneously, U.S. households are grappling with financial anxiety and a bleak economic outlook for 2024. Recent research indicates that 36% of Americans have no savings, and 65% report an increase in household expenses over the past year, while only 25% have seen an increase in income. Before we go further, please make sure to subscribe to the channel and leave a like below this video if you found this video informative. Concerns about consumers' financial health are escalating as credit conditions tighten and unemployment rises. A survey by Clever Real Estate reveals that 51% of Americans would run out of money within a month if they lost their income, and 29% would face financial depletion in a week or less. Matt Brandon, a data writer at Clever Real Estate, notes that Americans' savings levels are alarmingly low, resembling the period before the 2008 financial crisis. The lack of savings poses a significant risk, leaving individuals vulnerable to financial crisis in case of job loss or emergency expenses. The New York Times reported a surge in the number of clients being abruptly dropped by their banks. Experts estimate that thousands of people are losing access to their bank accounts and credit cards monthly, often facing restrictions on fund withdrawals for extended periods. This leaves many struggling to cover bills and purchase essential items. Although banks do not disclose specific data on account closures, analysts have observed a 50% increase in suspicious activity reports, SARs, which typically lead to abrupt account closures. Real-life examples highlight instances where customers, including businesses, students, and everyday people, were suddenly and unjustifiably dropped by their banks. The reasons for these cutoffs may vary, but the consequences are severe. Delinquent customers face the highest risk of account closures, impacting their ability to pay bills and harming credit scores. The justification from the bank's perspective is framed as a risk management measure, cutting loose accounts flagged by suspicious activity reports to avoid fines or regulatory investigations. Despite the rationalization from bankers, the human toll is undeniable. Individuals, including single mothers running small businesses, find themselves at the mercy of automated processes that prioritize risk management over personal circumstances. The lack of humanization in these decisions underscores the significant challenges individuals face when unexpectedly losing access to their bank accounts, resulting in financial hardships and disruptions to their daily lives. Amid the waning pandemic aid and rising inflation, millions of struggling consumers are facing a critical reduction in credit lines. According to the Federal Reserve Senior Loan Officer Opinion Survey, banks cut millions of lines of credit in the third quarter, creating concerns about the potential onset of a full-blown recession in 2024. Despite households and businesses expressing a desire for additional borrowing, fears about affordability at current interest rates or potential loan denials persist. Higher interest rates have led to a slowdown in loan demand, with the Federal Reserve revealing that 33.9% of banks tightened lending standards in the third quarter, compared to 50.8% in the second quarter. This represents incremental changes over the previous quarter. The credit crisis is affecting all major sectors of the economy, including commercial and residential real estate, credit cards, automotive, and other business loans. Banks cite reasons such as an unfavorable economic outlook, reduced risk tolerance, deteriorating credit quality, concerns about funding costs, and apprehensions about legislative changes and deposit outflows. In the 3 months ending in September, bank deposits experienced their sixth consecutive quarterly drop, totaling a decline of $174 billion in the third quarter. Major banks, including Citibank, Bank of America, Wells Fargo, and J.P. Morgan Chase, reported lower deposits. The ongoing turmoil in the credit cycle has resulted in significant challenges for banks, marked by a $620 billion mark-to-market losses on their Treasury bond portfolio so far this year. U.S. bank stocks have reached an all-time low in 2023 compared to the S&P 500 index, with the relative performance of the S&P 500 Banks Index being the weakest since tracking began in 1989. Over the past 11 months, the S&P Banks Index fell by 12%, while the S&P 500 rose by about 133%. Regional bank stocks have lost almost a quarter of their value, marking the worst relative underperformance since measurements began in 1941. This challenging credit cycle, unprecedented since the years preceding the 1929 crash and the Great Depression, is far from normal. The easy credit phase, fueled by the loosest monetary policy since 1946, saw reckless lending at low interest rates. The Federal Reserve's abrupt shift from quantitative easing to tightening, coupled with a 500 basis point interest rate increase over 18 months, has left the financial system hanging by a thread. The consequences of this abrupt transition are felt in a market economy grappling with the aftermath of irresponsible lending practices and a looming wave of defaults. The increasing fear among many banks of potential failure is compounded by a looming threat, a surge in defaults on commercial real estate loans. The expected wave of defaults is driven by record low office occupancy rates, making it challenging for property developers to roll over loans at high interest rates. Desmond Lockman emphasizes the concern surrounding the $500 billion in property loans due next year, particularly for regional banks heavily exposed to commercial real estate. U.S. bank regulators, in response to rising concerns, have been closely monitoring potential losses at banks linked to commercial real estate. Delinquent commercial real estate loans at U.S. banks have reached a decade high, fueled by the shift to remote work, resulting in decreased office occupancy. The volume of overdue loans, where property owners have missed multiple payments, surged by 30% to $17.7 billion last quarter, according to Bankrate data. Industry watchers predict a continued rise in properties under pressure, especially in the office sector, with Bankrate data indicating an increase of $1 billion in just a year. Observers, like Bill Mann from Bankrate, describe the state of commercial real estate lending as deteriorating rapidly, emphasizing that property prices are expected to decrease while loan delinquencies rise. The recent failure of Citizens Bank, the fifth bank collapse this year, adds to the growing apprehension. The government's intervention, shutting down Citizens Bank due to financial losses, raises questions about the Federal Reserve's strategy of maintaining high interest rates for an extended period. Critics argue that this approach appears to be causing more harm than good to the economy. The current mantra of withdrawing $95 billion a month in market liquidity, coupled with higher interest rates, is viewed skeptically. The ongoing difficulty in the Treasury financing itself at reasonable interest rates raises concerns. Some suggest that if the Federal Reserve persists in inflicting substantial losses on bank balance sheets through higher interest rates, the credit crisis may evolve into the next financial crisis, potentially hitting before the middle of the next year. The impact of this policy choice on the overall economic landscape prompts questions about its efficacy and potential repercussions. Your thoughts and comments on this complex situation are welcomed and appreciated.